Hi everyone, today I am going to talk about a simple but explosive setup given by living legend Stan Weinstein. This trading setup has changed my trading style and it can be useful to you also, even if you are a beginner or a trader who are experiencing some difficulty in trading. This setup will do wonders to your trading style. So stick with me, we will go into the video. So Stan Weinstein is a genius, he is a living legend, legendary trader, he has transformed many traders' lives. Or including mine. Okay, the strategy we are going to discussing about was built around 1970s, but it still works and will always work because the strategy is based on price action. Price action will always work. And one thing I would like to tell is this is an easy methodology. Anyone can start even if you are a beginner, but it is only good if you do it for a longer time frame, say for 6 months to 2 years. According to Stan Weinstein, if you are buying a stock today and selling it tomorrow, you are actually a gambler. It is not, Stan Weinstein framework is not good for swings like weekly, 1 week or 2 weeks if you are planning to trade like that. So I am planning to release this Stan Weinstein's entire trading strategy in 3 parts. So this is part 1. I will see how it goes and I will make it into either 2 parts or 3 parts. In part 1, we are going to see about the famous stage analysis by Stan Weinstein, how to analyze the 4 market stages, and we will also be seeing how to set up a chart according to Stan's framework, and we will be looking into triple confirmation pattern where we will be seeing the past winners, how to enter properly, etc. And we will also be discussing about the trade management, how to manage a trade once you enter, and then how to exit at a proper time. These things will be discussed in part 1. So before going on, I would like to say Stan uses an approach called as forest to tree approach. It is also called as top to bottom approach. It means Stan first analyzes whether the broader market is in a proper mood for the stock to take up, because if a stock has to take off, the broader market has to be in a proper condition. Otherwise, 3 out of 4 stocks will fail if the broader market is not in your favor. So he looks into whether the broader market is in a good position. Then within broader market, he looks out for the strong sector. For example, if you take a auto sector, he then looks into within auto sector which industry is doing good. Sometimes in auto sector the auto tires may be doing good, or the software that supplies to the auto cars can be doing good. So he takes that into consideration, and within that industry which stocks are performing better when compared to the other. This is how Stan approaches the stocks. So first we will look briefly about this famous stage analysis given by Stan Weinstein. Usually every stock undergoes 4 stages. One is stage 1, 2, 3 and 4. Stage 1 is called as accumulation phase. In this stage, the stock trades within a range. Okay, the stock trades in a range for a longer period of time. This phase is called as accumulation phase. This is the phase where bigger institutions usually quietly accumulate their stocks because they get stocks at a considerable bargain. After staying in this stage 1 for a period of time, the stock breaks out. Okay, this is the phase. Once the stock breaks out, it starts to move up. This is called as mark up phase, or also called as advance phase. So the stock is advancing. This is called as stage 2. Our focus will only on stage 2 because if your stocks or in any of these phases, this phase you may be entering too early. So this is the phase where you will be concentrating. After a run up comes the stage 3. Okay, stage 3 is also called as distribution phase, where the bigger players starts to distribute the stocks to retail traders who are very much frustrated by missing out this beautiful rally. They want to get into the stock anyhow. So the bigger players used to give the stock to the retail traders who don't know what is going to come. Usually retailers think that the stock will continue its movement into upside. But after this certain period of time, the stock finally breaks down here and then runs into stage 4. Stage 4 is also called as markdown phase or phase of decline. After decline, again the stock goes into a period of consolidation, and then it breaks up or it can break down. So when it breaks up, it forms a stage 2. When it breaks down, it again goes into a stage 4 phase. Okay, this is how the stage analysis should be read. If you are a beginner or you are having some stocks in your portfolio, go to it and then open the weekly time frame and see whether your stock is above the 30-week moving average and whether it is in stage 2, stage 3 or stage 4. So now we are going to see how we can set up the chart according to Stan Weinstein framework. For that we have to open trading view. So this I had already opened. So open trading view and change the time frame to weekly. For this we need 3 indicators. The first indicator is moving average, the second indicator is relative strength, and then we will be needing volume. First I will add volume here. Just search for volume in indicator section. A basic volume will be enough. Once the volume is added, I will look for multi EMA. Okay, multi EMA, or you can use even single EMA also. I'm using this multi EMA because you can use any number of 3 to 4 EMAs in one indicator, but for Stan's framework we have to use only one EMA, that is, I'm disabling all other EMAs, so I'm having only EMA 5, which will be 30-week moving average. Okay, so we have put 30-week moving average. So volume is here, and then 30-week moving average is here, and then the most important indicator which we are going to add is relative strength indicator. Okay, so I'm going to use Mansfield relative strength indicator. This is the exact same indicator what Stan describes in his book. You can see the indicator is published by the author called as Chester. You can use anything, but I'm using this for quite some years, so this indicator works nice for me. Okay, so what I'm going to do is I am just going to use this indicator. Okay, first, before going on, I would like to explain what is a relative strength indicator. Relative strength indicator is nothing but it measures the strength of the stock. For example, in this example, I am taken Triveni Engineering. So in this relative strength indicator measures whether Triveni Engineering, the stock, is performing better when compared to that of the broader market. So that is called as relative strength indicator. Relative strength indicator should not be confused with RSI indicator, because RSI indicator measures the strength of the stock before a particular period of time. For example, Triveni Engineering as of this date is performing better when compared to this date. Okay, this is called as RSI indicator. Okay, but here what we are discussing is whether this stock is performing better than the broader market. Okay, if the zone is above the zero line, it is performing better than the broader market. If it is below the zero line, it is performing poor when compared to the broader market. Okay, so first we will make some changes to the indicator, because this indicator has been developed by for US markets, so we have to make some changes. You can see once we click the settings in the input, change this broader market index to Nifty 50, or you can also use the Nifty 500 also. Sector and industry is optional. In style, I will use only the index. I will switch off sector and industry as of now. This is the zero line. Zero line is nothing but whether the stock is positively performing above it or below it. Okay, so I will change the color here to blue, so you can visualize it properly. And then in inputs, For weekly, use the number 52. Why 52? 52 is nothing but it says that you are comparing the performance of the stock against the broader market for a one full year. So 52 is one full year. For daily, the time frame used is 200. 200 is 200 trading days, usually comes around 1 year. For monthly, they say use it for 10 months, so almost it's 1 year. Okay, so 1 year is the time frame. If you want to look into for shorter periods of time, you just have to change the time frame here to 25 also. If you are using 25 then or 26, then it means you are looking it for 6 months period. Okay, so I have always used it for 1 year period because it gives lesser wrong signals. Whipsaws are very low when you use for weekly time frame. So this is how you set up a chart. Okay, if that, see here, if the this line is called as relative strength line. If the relative strength line is above this zero line, it means the stock is performing positive or better when compared to the broader market. If the RS line is below the zero line, it means that it is performing poor when compared to the broader market. Okay, so you should be avoiding stock that is trading below the zero line, and you should be in the stock that is trading near to the zero line or above the zero line. Okay, that's it. This is how you set up a chart. So next what we are going to see is about the Stan Weinstein's triple confirmation pattern. By triple confirmation pattern, what I mean, he uses three things. One is first is the price confirmation. For price confirmation, always the price is ultimate. Okay, so the price of the stock should be above the 30-week moving average, as I said already, and the price action should also be considered. It should form a considerable base. So it should form a considerable base as in stage 1, as we saw in the stage analysis, before the breakout. Okay, and the stock price should have moved at least 60 to 70% before the breakout. For example, this is the range. This range should be at least 50 to 60%. Okay, 50 to 60% before the breakout itself. The movement should have happened. Okay, and one should never attempt the trade before breakout, how tempted you are or how good the setup is looking. Don't trade before the breakout because it will test your patience. You will lose your confidence also. The second confirmation is about the volume. Volume on green days should be bigger on consolidation days. This is the very important. In base itself, we should be picking up volume, not only on the day of breakout. You should look into how the volumes are responding in the consolidation days or in the base. Okay, when the stock is forming a base, you should look into the days. When the stock is up, you will be seeing a good increase in volume. When the stock is down, you will be seeing a smaller volume or a small red volume day. Okay, the volume should be 4 to 5 times higher the previous week on the day of breakout. So more high, more the better. Okay, and also after the breakout, the volume should be keep on increasing. Okay, once the breakout, if you see a volume like this, the next subsequent week you should either see like this or see like this, and when the volume is decreasing, your volume should be decreasing. Okay, this is what you should be looking for, volume confirmation. And the third is the relative strength line. And the third is the relative strength line. As I already said, relative strength line should be in positive zone or hugging the zero line at the time of breakout. Okay, better is that line moves from negative zone to positive zone in a gradually rising manner. That is very important. Don't look into the stocks where the relative strength line is showing many whipsaws. For example, if the relative strength line is going up and then going into the negative zone and then it suddenly goes into negative zone, don't look for that. Look for a clean stock where the relative strength line is trading in a negative zone. For imagine this is the zero line. Okay, imagine the stock is trading into the negative zone for a considerable period of time and then it breaks out. Okay, we will see in the, so I have 4 to 5 examples for you which we will be seeing. First is the apparel industry. This stock in June 2017, this around June 2017, it started to form a base. You can see a good head and shoulder pattern that formed. This is one shoulder, this is the head, and this is again a small shoulder that is formed. Okay, during this time you can see the RS line tend to stay below the zero line for a considerable period of time, and finally it breaks into the positive territory after a long period of time where it spent most of the time below the zero line. Okay, once it starts to come into the positive zone, will you enter? No, because the price has not confirmed at its breakout. Okay, without price confirmation, never enter into the stock, even though you are seeing RS getting positive, volume getting better. So two signals are good here. The third signal, that is the price has not yet confirmed. But what you can see here in this base, you can see the volumes are constantly increasing. Volumes are constantly increasing even before the breakout. See how many up days you are seeing. Okay, so finally what happened? Finally on one fine day in around 13 June 22, the price broke out this consolidation zone. You can see the RS is reaching a newer high. If you draw a line here, the RS line has reached a new high with superb volumes. Okay, superb volumes, the price has broken out finally. Okay, so also you can see here the volume on the next week after this breakout, the volume on the next week is also up. So the volume continues to rise, and in the coming days also you can see, coming weeks, sorry, the volume keeps on increasing. So the volume keeps on increasing. On every up move, the volume keeps on increasing. On every down move, the volume is decreasing. Okay, so after this breakout, the stock started to move, and then it finally gave around 1563% before it started going down. Okay, this is the first example I am showing you. So this is the second chart, APL Apollo tubes. The stock started to form a base here, you can see. So what are the three confirmations? One is the price confirmation. The price starts to break above the base, and the price has already run up 162% before the breakout. And you can see the volumes that is coming up on even before the day of on the day of breakout. You can see the extraordinary breakout here. You can see the volume here, sorry, you can see the volume here, you can see the up volumes here and all. Okay, so also you can see the RS line is already into the positive zone, and it has now broken into a new high. Okay, once the stock breaks out, it starts to perform, it starts to move, and it gives around a 303% move before it breaks down here. Okay, it breaks down here, and again it forms a stage 3 and then goes up. Okay, so next example is Indian hotels. You can see the Indian hotels here. I already marked these lines so that, see how common it is. The stock forms a base here, it finally rises above the 30-week moving average. You can see the rising 30-week moving average, and the price breaks out here with huge volume here. Price breaks out here, huge volume here. RS reaching into new highs. Okay, RS reaching into new highs, and the RS is already in the positive zone. Once the stock breaks out, it starts to give tremendous move above the 30-week moving average, and as few weeks before it has given around 400% move. Okay, so this is the power of trading Stan Weinstein framework. And next stock I'll be discussing about Bell. The stock formed a base here, and you can see here, this is the base I'm talking about. You can see the volume was heaviest during this stage, and the RS line also entered into positive zone and then broke into new high, but the price has not broken this stage consolidation, right? So what happened later, after a few weeks, the stock started to form another base, okay, another base, and you can see the RS line goes into negative zone, and again finally it breaks out one day. The RS line enters into the positive zone with price confirmation. See the price confirmation, and volume also increases. On 2 breakout days, the volume increases here, and the volume increases on the subsequent week also. You may think that this volume is not as high when compared to this, because the accumulation, the most of the accumulation has happened already over here. Okay, this is the huge accumulation that has been done by that would have been done by the institutions. So here, even though the accumulation has happened, the stock started to show a movement here only. So the volume is not that high when compared to this, but you can see here the average volume, it is always greater than the. So this is where you buy, and after that the stock kept on moving, gave around 314% before it started moving down. And the next example is about Birlasoft. You can see the stock's price confirmation with heavy volume and RS in the positive zone. Okay, and also you can see that the stock has moved. How much the stock has moved? Wait, stock has moved from its low to around 50% right before the breakout. This is what I am talking about. So the price also should have moved from its low for a considerable percentage before the breakout begins. Okay, so these are the examples I had shown. I will also show you one more example if possible. That is wait just a minute. I will. Cyient was a fantastic stock. It has worked me wonders. I was trading here exactly. You can see the stock started to form a small base, and it finally broke out. When it broke out, see the volume, highest ever volume that is coming in the past 1 to 2 years. Okay, this is the heaviest volume that came out on the day of breakout. And you can also see once the breakout happens, even though the breakout has happened, you can see the volumes getting bigger and bigger. Okay, every week the volumes are getting bigger, and when the red candle is being formed, you can see the volumes are very less. Okay, so what is the triple confirmation pattern here? The price has broken the base, the volume has increased, RS is in positive zone, and it's also reached a new high in the past few weeks. And in the base, it was in the negative zone, and when the stock started to break the base, it's converted into positive zone, and the price of the stock has moved around 40 to 50% before the exact breakout that happened. Okay, so all the Stan's framework fits well into this. So the stock later moved up to around, it would have given from the breakout time, it would have given around 118 to 119% before the stock started to fall off. So this is how you trade Stan Weinstein framework. So coming to the exit, okay, Stan Weinstein gives us 3 simple exit strategies. He actually gives us 2, and I had added one third exit strategy also. The first strategy, what he says, is very simple. Just at the break of 30-week moving average, if the 30-week moving average is broken, just exit the stock. And one thing I would like to add is you have to wait for the close of the candle. Not many of the time what you will see is the price dips into the 30-week moving average and then it forms a long wick and then comes back. So this wick will be formed. Okay, here the long wick will be formed. The price goes down below and then it forms a long wick and comes back. So you should wait for the close, okay, before exiting. And second is break of trend line. Okay, Stan Weinstein prefers trend line for entry also for exit. I would prefer trend line for exit only, because particularly when the stock is giving huge moves, it is imperative that you need not wait for break of 30-week moving average unless you are a investor. If you are a trader, you should be exiting the stock once it breaks the trend line with heavy red candle with a volume increase. Okay, the third one which I would like to give is, it's not a stand strategy, but it should be only used by long-term investors who don't want to get out of the stock easily, who want to ride the entire trend. They can use this strategy when they can exit the stock when the RS enters into the negative zone. From the positive zone, when the RS line enters into the negative zone, they can exit. Okay, otherwise they need not exit and get stopped out unnecessarily. But the problem with this is you may give too much to the market. Okay, too much, you can give too much to the market. So let us see how we can exit in the stock examples I gave earlier. Okay, so first stock we were talking about was Upper Industries, right? So this stock, after the breakout here, it started to move up. Can you see, not even once the 30-week moving average has been breached. The stock comes near this 30-week moving average, starts to move up, comes near. Can you see here, the stock came this much, touched the 30-week moving average, but it didn't close below it. It started to show a superb tail and then it moved up. Okay, that is why you should not exit the trade when it is giving you huge returns. Particularly, don't exit the winners too early. And this is the first time the stock closed heavy volume below the 30-week moving average with increased volume here. Okay, with increased volume here. Okay, this is the time you should start considering the exit. For a better exit, within a week you would have lost so much of money. For a better exit, what I would say is, you can exit the stock once the trend line is broken. How do you draw a trend line here? I will just show you. See, this is the trend line and any 3 touch points would be fine. Okay, so this is the trend line where I am drawing it. Okay, so you can see the trend line here. This is 1 touch point, 2 touch point, 3 touch point, 4 touch point, 5, 6, 7. This 7 touch point trend line breaks out here. So if you are a trader, you could have exited earlier also here itself. Okay, instead of waiting for such a long period of time, you could have exited here also, or at least 50% here. And once this candle gets printed, you could have exited. You need not wait for this candle to get closed, because this candle already has closed below the 30-week moving average. If you see here, it has already closed below the 30-week moving average. So once this candle starts getting formed here itself, you can exit, or at the least you can exit once this pivot is broken. You can see the weekly pivot. It's a good pivot that has been formed in a few weeks back. Once this pivot is broken, you can exit. These are all valid strategies. Or you can also exit based on RS. As I said, once the RS enters the negative zone, you can exit. But the problem with this is you would have given out too much to the market back. Okay, so almost if you had entered at this candle's close, the volatility is too much. You would have given around 40% of your profit to the market back. So this is how we could have exited this trade. This is the second stock, and this stock was little bit tricky because this stock really closed here below the 30-week moving average. Can you see here? This stock closed below the 30-week moving average, and the volume was also higher than the average. Okay, volume was also higher than the average that week, but it didn't break this previous pivot. So either if you are an aggressive trader, you could have exited here, but if you are very conservative or you are a long-term trader, you are good patience, then you could have waited for this pivot to getting broken, and then the stock started moving into a stage 3, and then from this stage 3 it again gave a breakout and started to move up. Okay, so the final exit came out here when the stock finally closed below the 30-week moving average. This is the point you should have exited. Even though the stock has not fallen much, you should follow a framework. If you have to follow a framework, you should exit here. Okay, then coming to the Indian hotels, you should have exited here when it closes below the 30-week moving average with heavy volumes. See, always don't worry when the stock after you exit starts to move up again, because you have made good amount of money here, right? You can always enter into the stock again at the breakout of this line. You can always enter the stock again at the breakout of this line, or you can look for some other stocks where you will be finding a lot of opportunities. So how would you feel if the stock has, after breaching this 30-week moving average, how will you feel if the stock straightly stumbles down like this? You would lose considerable amount of money. Okay, so don't worry if you exit pre-emptly. If you exit yearly, don't worry about that. That is what I would like to say. So the stock finally gave an exit here when it closed below the 30-week moving average. So this is what I am saying. If you have to wait to the RS line to get into the negative zone, you would have lost some more also. Okay, you would have lost around 20% more when compared to the traditional exit as given by Stan Weinstein, right? Or if you are an aggressive trader, you can exit at the break of this trend line. This is the trend line, 1, 2, 3 touch point, 3 and 4 touch points. So can you see the touch points here? Any trend line is valid once it has 3 touch points. So to touch point 1 and touch point 2, touch point 3, touch point 4, touch point 5. So here it completely broke out here, and it also broke the moving average also. So this is the point where you have to exit. It is also imperative to note that it also broke this beautiful pivot that was formed weekly some week back. So this is the exit strategy that you have to follow when exiting the stocks as per Stan's framework. So that's it for today, guys. These are the things I wanted to explain to you in part 1. I think it has taken considerable time, around more than 30 minutes for explaining these things. I wanted to explain in a proper way, so it took time. Thanks for patience and thanks for waiting. In part 2, we will be seeing how to modify Stan's setup. By means, what do I mean is, most people don't identify the correct stages and enter into high probability trade setup properly. So I will be looking what modifications or what thing you have to exactly look into Stan's setup when trading the framework. And I will also be discussing to use the setup for smaller time frames. Okay, using it for smaller time frames may be difficult at times. So I will also be discussing how to use the setup for smaller time frame, and I will also be discussing how to use this same setup to trade indices. By indices I mean you can trade mutual funds based on this. You can trade Nifty 50 or ETFs like Nifty 50 ETF, Nifty Bs, even gold base or whatever it is, the same setup can be used to trade indices and ETFs, because I believe that for some people it may be very easy to trade ETFs because it doesn't give wrong signals more often. The whipsaws are low, volatility is very low, and it usually gives good risk and reward ratio. And I will also be looking or giving a small intro to how to find scanners for finding Stan stock. Don't expect it to be too complicated or something like that. It will be a very basic scanner where you can find the stocks that fits into the Stan strategy. Okay, so these things we will be discussing in part 2. That's it for today, guys. If you like my video, share, subscribe, and if you are having any doubts, post it in the comment section. I will individually reply to all your comments. Thank you. See you soon.